Hey everyone, Sean with Families Creating Financial Freedom. Hope everybody's doing well. It's tax season, and so a lot of people out here, when I'm going about knowing I'm a financial advisor, like to ask me a question, or really two questions. First of which is, what can I do to save on my taxes? And two, what is the difference between an IRA and a Roth IRA? So I thought we'd discuss that today. Now, do me a favor, before we get into the meat of the topic, how about going down, liking this video, and following my channel? I like to do videos a couple times a week that educate people in money matters. I try to break it down in very simplistic terms so that anybody can understand it, but you can ask questions, make comments, do things like that allow us to have a dialogue. So it's not going to hurt you. Hopefully you find it very helpful. So first and foremost, let's talk about what an IRA is and what a Roth IRA is. An IRA and a Roth IRA are really just part of the IRS tax code. An IRA falls under the same tax code as a 401k if you work for a business and they allow you to have retirement savings. That's a 401k. If you work for a government or a nonprofit, that could be a 403b. If you're self-employed, you might have what they call a SEP-IRA, self-employed IRA. A 401k, a 403b, and a SEP-IRA have higher contribution limits than an IRA. An IRA is an individual retirement account. They all fall under the same tax code with the IRS, and what that is you are allowed to contribute to that account with pre-tax dollars. I'll talk about that in just a second. The downside of contributing to a retirement account is that it is earmarked for retirement only, age 59 and a half. That's the earliest time you can technically touch it without a penalty. Now, there are some simple provisions such as hardship, buying a home, educational expenses, but there are really strict rules with it. So I tell my clients, just think of it as retirement funding and leave it at that. If you access the money prior to 59 and a half, in addition to paying taxes on it, the IRS gives you a 10% penalty. So that can really have a big impact. If you are somebody that has a tight budget and you don't feel comfortable safely setting it aside for retirement and never touching it, it might not be a good thing. But let's talk about what's pre-tax dollars in case you don't really understand what that is. If you are a W-2 employee and you look at your pay stub and you have health insurance, you will notice your gross income, meaning before they take anything out. So let's say you get paid hourly. For sake of math, it might be 40 hours at $20 an hour, and you would see a gross pay of $800 for the week. Then let's say you pay health insurance of $50 a week, just for round numbers. You would see that being deducted next. If you have a 401k and say you contribute 3%, you would see a deduction of 3% of the $800, and then you see tax calculated. That means it is a pre-tax deduction. So contributing to a 401k or a 403b reduces the income that the IRS sees for calculating how much taxes you pay. That is how they consider it a pre-tax deduction. Hope that's simple. Now, some people work in a structure where they don't have a 401k or 403b, and so they might start an IRA or they've left an employer and they roll their retirement account into an IRA to grow and be held and managed until retirement. Any of those situations, that is all pre-tax dollars. What that means is later in retirement, when you take the money out, you're going to pay ordinary income tax, meaning your income taxes on that money and the growth. So let's say you had $100,000 that you put into retirement, but over 20 years, it was $300,000. You're going to pay ordinary income tax on the $300,000, not just what you put in the $100,000. That can impact you in retirement when you're playing what I consider the tax game, because you take a portion of your Social Security. If you have a pension, those are all taxable, and add to that your withdrawals from the retirement account to potentially increase your tax bracket. So if you are in the lowest tax bracket now, contributing to further reduce what you pay in taxes may mean that when you get into retirement years, you pay more in taxes because your tax bracket may be higher. If you don't know what a tax bracket is, what that means is lower income earners may pay a 15% federal bracket plus whatever state charges for income tax, and the wealthier you are, the more income, the higher percentage. So that's income brackets. Might be 35% if you're really wealthy for a tax bracket versus 15% for somebody making maybe $40,000, $50,000. So do you want to reduce your income tax if you're making $40,000, thinking that when you're 70 and you've been very successful and accumulated wealth, that you might be in a 25% income bracket to pay 25% income tax on your income versus 15? Well, I tell my clients the difference, if you're in the lowest bracket, may not make sense to contribute to the IRA, knowing that I call it kicking the can down the road, will pay more in taxes later. But that's for you and your financial advisor and tax accountant to advise you on what to do. A SEP-IRA, a 401k, or 403b allows you to contribute much more to that retirement account, reducing your income, but effectively saving a lot more for retirement. The reason those exist at a higher rate is pensions are getting phased out. Fewer and fewer employers offer what they call a pension, including state organizations, because they would carry the liability to make sure they earmark enough money to pay you a guaranteed income in retirement for an unknown number of years. Social Security is simply a government-managed pension, or government-managed annuity is another word. We'll talk about annuities in a different video. But because of that, the IRS allows certain funds, 401k, 403b, self-employed IRA, to have higher contribution limits. An IRA also allows what they call a catch-up provision. So if you're over age 50, you can contribute an extra, generally, consistently in the last years, it's been an extra $1,000 a year to build up more retirement savings in case you haven't planned in your earlier years adequately. Now, I said I was going to talk about the difference between an IRA and a Roth IRA. I explained what an IRA is and how it's pre-tax dollars. A Roth IRA is just the opposite. It is after-tax dollars. So it's not going to help you in the current tax year to put money into a Roth IRA. Where it's going to help you is in retirement, because it is after you've received your paycheck, after you've taken out for your taxes, you can contribute to a Roth IRA. The IRS in turn then says you have paid taxes on that money and the growth you will never pay taxes on again. What do I mean? So let's say pretty consistently the IRS changes every year, but you might be allowed to contribute $6,000 a year to a Roth IRA. Let's say over the X number of years you have $100,000 in a Roth IRA, but by retirement that same $100,000 has grown to $300,000. Well, guess what? You're never going to pay taxes on that $300,000. That's going to help you significantly in retirement manage your tax brackets. You can access that money without fear that it's going to cost you more in taxes. But the downside of a Roth IRA is if you make a lot of money now, you may not be able to contribute to it. Wealthy are not allowed to contribute to Roth IRAs. And there's a gray area in between that they phase it out. They do, at the same time, have catch-up limits to, just like an IRA, if you're over 50, to contribute and catch up. So that is, I tell my clients, if you're eligible and you want to contribute to a retirement account, you want to try and maximize a Roth IRA every year because it is going to set you up for success in retirement. Now, it does carry the same provision that you can't touch it before age 59 and a half without penalties, meaning if you take it before age 59 and a half, you're going to pay a penalty. It is earmarked for retirement. But I hope this has been a simple explanation of an IRA versus a Roth IRA and why you should aim to maximize a Roth IRA every year and examine if you should contribute to an IRA every year and what it should be. I had a client last year that had a huge step up in her income, and she contacted me in a very upset because she had to pay a lot of taxes she hadn't planned for because she hadn't thought about the fact that she had made a lot more money that year. And she said, I really need to contribute to my IRA and save on my taxes. And I said, okay, so understand the most you can put in this year is, I think it was $7,500. If you come up with $7,500, ask your CPA what that is going to save you in taxes. And she came back and she said, well, my CPA said it's going to save me essentially, I think it was a little over $500 in taxes for her because it wasn't going to reduce her tax bracket and just the way things worked out. I said, okay, so you're going to have to come up with $8,000 or you're going to have to come up with 500 and some change. Are you able to come up with that larger number to save that little bit? And she said, well, not easily. I said, or you pay the taxes now in that bracket. She was still in a low tax bracket. And know that you haven't, kicked it down the road so that eventually you're going to pay a higher tax rate anyway on it. It's a discussion you should have every year as to what you should contribute to your IRA. But I can tell you the easy discussion is if you are eligible for a Roth, you should try to maximize it every year. Hope this has helped. Again, if you found this an easy explanation to understand what the difference is between an IRA and a Roth IRA, and that it's simply an IRS tax code and how it works, do me a favor, like this video, subscribe to my channel, feel free to comment or go to my website, which is linked in the description, and email me. I'm happy to have a conversation with you about the ins and outs. And as a financial advisor, I'm happy to help you if you don't have somebody working with you. Until next time, take care.